Okay, here we go. So, what I'm doing here, everybody, is we are going to learn how to execute the newsletter. Um, what I've seen after working with Eric and LCR for such a long period of time is that the biggest stop for most new traders is kind of executing the newsletter properly and knowing how to pick the different asset classes and going through each segment of it and doing it very robotically in kind of the way it was meant to do. So, that being said, I'm going to make a short video here on how to do this. Now, this is only going to cover the newsletter itself, not the top 20. If I need to make another one for the top 20, we'll go ahead and do that too in the future. So, here we go. Starting off, basically, there's 5 steps. We're going to make this very, very, very simple. And I'm going to walk us through each step and really try to handle any concerns that we've had over the years on these things. So, first thing is to read the write up. We'll go to the next slide and look at all that, but then we identify what type of trader we are. We select the derivatives out of the 20 different options on the newsletter, and we put in our orders, and then we go and do something else because this really is about trying to get more passive. So we go to the newsletter, and here we go. I actually took a screenshot of the second issue of October. So like I said, this is where we get the macro insights from the newsletter itself. Since many of the trade recommendations are based on strict algorithmic formulas, this is where a dose of discretionary guidance from the veteran traders comes in handy to guide the selection process. Remember, at the end of the day, it is what you guys want to do for the execution. So reading through this, right, we kind of get an idea of what's going on and kind of the overview of the outlook of LCR. Um, from there, if you want to continue with that outlook, then go by what the recommendation is. In this case, the very bottom line, kind of after everything goes through it, says bottom line, given our outlook, investor trend suggestions are still a way to go. So that being said, go to the next one. We are identifying what kind of trader we are. Now, this is the part that's going to take a little bit of research and a little bit of introspection. Most of us kind of don't really know what kind of traders we are initially. We need to go and really do whatever process you have to do to understand if you want to be somebody who is more aggressive, if you want to be somebody who is more conservative, if you want to be somebody who is trying to accumulate for the long haul, or if you're really just trying to kind of make income. And so, like I said here, the playbook gives options as to what type of portfolio you want to have. The investor trend is going to look at the long-term buy-side accumulation levels via short put strikes at attractive macro levels. This is very, very hands-off and goes very wide. So what you're going to get here is really only accumulating to get long, following the 100+ years of a massive, massive bull market that valuations are going to improve and over time and go up and up and up. But that in that case, we are really never going to be selling calls here. We're really going to be looking at very wide out of the money put sales or staying in cash. The trader trend is going to be more aggressive, identifying short-term trend changes and offering suggestions to sell calls in a downtrend if that's the case, which obviously this year it has been. And trading those bull markets is tricky. And so we've been having kind of wide call sales coming up where you're not getting a whole lot of premium, but at the same time, you're not getting your face ripped off when the 15% rally in a week tends to happen. In each of these, since in each kind of iteration in each derivative, there's going to be a investor trend and then a trader trend. And inside those, as you'll see, there's going to be an aggressive and a conservative trade recommendation. So we jump over to the next one here. And here we go, selecting our derivatives. So I just took a screenshot of the bond section. Now there's not only bonds, we got a bunch of stuff on there. There's going to be metals and energy and SPY and NASDAQ and Russell and all that stuff, right? So This just being said on the bonds, as you can see when we look at the first one, the HYG, right, the high yield corporate bonds. You have your investor trend, which is neutral, and if you're aggressive, then guess what? You are selling a naked put in the December 70 strike, and you're basically just allowing it to accumulate. So it all depends on what premium you get for it, and you're throwing it out there, and you're looking to own some HYG stock if in December it is trading under 70. And then if you're conservative, you just maintain cash. Going down, if you're a trader, as you could tell, you're selling to open the November 75 naked call. So we want by November 18th, in that case, we want HYG to be trading under 75. And as you can see, we actually have a conditional position to exit at 75.01. So after you put that trade in, if the underlying ETF hits 75.01, you close that naked call. You don't want to ride it up and then end up short, 100 shares per contract of HYG. And it goes down, kind of each one is like this. And you can kind of see a trend here, right, of the investor trend with the trader trend. And it goes through and we'll go through a whole newsletter after I run through this little PowerPoint slide presentation. So like I said, each section here has 3 recommendations. If you took every single trade in the playbook, if you picked investor or trader trend, it'd be 18 positions if you were aggressive, right? And you took trades in all of them. For some investors, that can be too much, and we'll see that a lot. In this case, I recommend picking a smaller cost instrument from each section, or just buying junk units and creating a vertical credit spread to help save on margin. So in essence, what you're really trying to do is, if we're looking at all the bonds and you can't afford to get HYG, TLT, and LQD, and you're aggressively, you're an aggressive investor trend trader, right? So you're going and you're trying to sell all those puts. You're selling the December 70 for HYG, the December 93 for TLT, and you're trying to sell the December 99 on the investment grade corporate bond. What you can do is either one, just kind of go with the lowest cost one, which would probably be HYG. It's going to move a little different, but it's going to save you some money. And bonds, generally will tend to move together overall, but again, nothing's certain in the markets, and periodically these things could really disconnect. So my favorite thing to do here is actually to turn these into credit spreads, right? So if you sell the put, then all you have to do is just buy a further out of the money put in order to make a bull put spread, right? And so in that case, you just kind of have to measure, how much help you need on each contract via risk graphs and those kind of things in order to kind of mitigate what your risk is. Now, the downside of doing that will be that if you leave that credit spread on through December and your price is actually trading below the strike here and you have that long put, you'll end up taking a loss, because that your platform will typically shut down your long put and to close out your short put too, and close the whole position out at a loss. So if you want to accumulate, you kind of have to make sure that you close those long units, and then just take allow assignment to happen, allow accumulation to happen. So that's kind of how you do it here. Now, we are assuming that most people that are getting this newsletter have some idea of how to trade options, more than just kind of single strike, single strike, buy a put, buy a call, and go all in. We need to know how to sell units as well. If you don't, then we can definitely make some more videos in the future explaining exactly how to do it and walking through on those things. Okay, so I just want a little feedback going forward if we actually need to do that. I'll do a little bit today so we can kind of see an example or two, but going forward, it's important that we actually learn a little bit of that kind of risk management here. Okay, so going on. Order entry, right? I just put a little screenshot up there of the options panel in Interactive Brokers. And like I said here, well, any multi-asset broker can be used. I prefer Interactive Brokers for multiple reasons. They have the best portfolio margin by far. You can get really great commission spreads. It goes on and on. So I usually use those guys, whereas I use for charting, I typically use Thinkorswim. What I said here is I personally prefer to set all my orders up on Sunday and then fire them all off Monday morning, and a few minutes after the open when spreads have calmed down a little bit. The key, as always, is to understand how much risk and portfolio margin you're taking on when you place these orders. So once you put all those trades in on Sunday, like the newsletter comes out, you sit down, you read the newsletter, determine what kind of trader you are, you go through and you pick all of your positions, and then you just go and you set them all up. You set them all up, just waiting in queue, and then in the morning when the market opens, you hop on. Then you just, as long as they're as long as the market actually opens, you can just queue all these things to go. All right, and then after that, here we go. We're taking a little vacation. And like I said here, honestly, the newsletter is designed to set and forget. You take your stops, accept your accumulation levels, but don't screw around with anything. I personally tested this newsletter for the last 5 years, and really, it's like Novocaine. It definitely works over time. That's what trading is. Trading, is going to be all about discipline and over the long term and remaining calm and managing risk. Okay? So from here, what we're going to do is we're going to jump out of this guy, and we're going to jump over to here. Oh, where'd it go? Oh, here we go. Okay, so from here, what we're going to work on is we're just going to kind of go through a little bit of the newsletter itself, right? And from here, kind of looking at the October issue, right? We have the featured trade recommendations, suggestions, the Exxon short put, right? And we also have the Intel BFF right there, right? So where we're looking at actually selling to 2250 April puts in order to pay for that bull put spread. We're going to look at doing this with a conditional. We're actually going to taking a big credit for this, and we got a target. We have our stops, always using the underlying asset for those things, and then we want to obviously always bid to get our units back at 5 cents, because we never want to carry those things. It's over time, it's been shown so many times that we never want to try to run short units down to zero, down to expiration. When they hit a nickel, get out. It's not worth them running back in your face. So from there, we're going to all these different bond and ETFs. I ran over those things. Then we go over and we have our international ETF trade maintenance suggestions with EFA and Mexico, and then we got Brazil. Again, we're deciding what we are, right? So are we investors? Are we traders in this issue? Are we going to copy the issue and just go investor trend? If so, are we going to even trade the neutral one, right? Or are we going to kind of hold that trend? Again, this is for you to decide. It's the discretionary part of trading. So, from what your ideas about yourself are and your ideas about the markets, go in, but always manage your risk, always take your stops. For example, when you look at like the MCSI, Mexico Cap DWW, that investor trend, right, is a bullish hold position. So what we're really doing here is actually we're looking to, again, kind of create a what really turns into a kind of a long position here by selling these naked puts. Now, since you're selling the 48, right, and you're also selling that bull put spread, you're really actually kind of creating a more aggressive long position here. But as you could tell, when you do that, when you get these spreads on, you are going to have to put in stops. You are going to have to close out at a target instead of just going to accumulation like it would be with some of these other recommendations. So always make sure you do that. And again, we can do all these things. If you need to free up margin with this stuff, like I said, you just buy some out of the money junk units. And like for the Mexico one I just said, maybe you would sell, or maybe you would buy a December 45 put or two, and just to kind of create more of a, or less margin hogging type position here. So, looking into that, again, we kind of got to play with our, we have to kind of play with our risk graphs in order to see exactly how much we're risking on those positions. Okay, so as we go through, it's kind of the same thing over and over, you guys. And we just kind of keep on walking through all these things. And, oops, sorry about that little blink in there. And we got all of our commodities and, healthcare ETFs, all that stuff. So for me personally, I usually in neutral markets will just maintain a cash position. I tend to be a more conservative trader. So I won't sell those units quite as often. But again, that's just me, right? I've tested both sides of it out on demo. And if you have the room and you want to accumulate, or if you just want to run and do little credit spreads, it works over time. Neutral markets can be really, really, really nice if you're range bound to just collect premium every single month, every couple of weeks, and you nickel and dime it, but that stuff adds up. All right, so we keep going, and you could tell all these trades tend to be somewhat similar as far as when we get the triggers to be bullish on these positions or bearish in some cases. All right, so knowing that, let's do this. So we got that, healthcare, U.S. major markets, here we go. So going all these. So let's go check out, after doing all that, let's go say that we were going to do the ExxonMobil trade, right? Or better yet, let's go do the Intel trade. So if we're going to do the Intel trade, then what we want to do is we're going to be, like I said, selling two of those 25.50 naked puts, and then doing the bull put spread with the 27.50, 37.50. Okay, so here we go. So I'm on Trader Workstation, so Interactive Brokers, and I'm on a Mac, so I'm not sure. It might be a little different than a Windows machine, and so hopefully you can kind of follow me through with this. So what we're going to do, we're going to work on building out that Intel trade, right? So as you can see, I pulled up INTC, right? Now from here, what I'm going to do, I'm going to go and we're just going to select the strikes, right? So we go to Strategy Builder, and we're in April, so we're going to sell the 22.5 put, right? And then we are going to buy, right, the 27.5 put, and then we're going to sell the 37.5 put. Now from here we have to double up on this guy, so we're going to sell two of these, and as you can see, we're getting kind of around a $9.50 credit is what it's saying now. This is just a demo account, so it's not going to be totally accurate, plus this trade should have went on a while back. So what we're going to do, we're just going to kind of set up how to do this. So once we have this thing built out, all right, we're just going to add the whole thing to the quote panel. All right, so it pops up here in the quote panel. Okay, so then all we have to do from there, we can go in our quote panel, and we can pull this thing up. And we can set it to say, all right, we're going to get this sucker for a $10.50 credit. So we'll set 50. Oh, okay, so we can accept that, right? So here we go. Now it's here. So now we just got to put our stop loss and profit target on. Pretty simple, right? We just attach bracket orders. Right? We'll put this thing as good to cancel. And for these, it's pretty easy. All we're going to do is we're just going to change both of the sell orders, right, to be market orders, and we're going to set them to be conditional at the underlying price hitting a certain, or hitting whatever the profit target and or the stop loss will be. So what I do here is we can go ahead and just, we can right click on it or double click. We can go to condition, and we're going to say that this one is going to be stop, right? So we'll say price for Intel is going to be less than is 1934. Cool. So we got that. We're gonna preview it. So it hits that and we're good to go, right? Accept it, and then we're gonna say that this one, we're gonna set all this stuff, it's gonna be market order, good to cancel. Now this one's also gonna be a market order, and good to cancel. But this guy is gonna be our take profit, so we're just gonna modify the condition. And we're gonna say price of IMTC, boom, boom, greater than, this one I believe is 36.98. So we're gonna go here, accept. Alright, so they're both gonna be market orders, right? We're just gonna close these things out. So just if we look at them just to make sure, right? We got order ticket, closing. Okay, so accept that. Go down here. We can look at order ticket. I'm gonna sell here, right? So all these things are gonna have their condition. This is over 36. And we'll and then all you have to do, once those things are all together, right? Everything's good. You double, triple check the whole deal. You can even preview orders, check your margin impact, all that good stuff. Once you're in, transmit, send it along, and there you go. It's ready to rock. All right, so easy enough, yeah? Again, you guys, if you have any questions, please don't hesitate to comment on the YouTube page or send a message to LCR Financial Group, and we can make more videos on how to put these in. Also, please follow me, LCR Think Tank, on Twitter, and we can chat on there as well. All right? Okay, everybody, have a great rest of your week.